Well, thank you very much, Fred. That was enormously kind. But my real identity is a professor at the LSE. That's who I really am. If you'd woken me up in the middle of the night when I was at the EBRD or the World Bank or in the British government and I'd been too sleepy to think my answer through and asked me who I am, I would have said professor at the London School of Economics. So it's a great pleasure for me to be back amongst the thinking classes and to be with you here today. And I speak to you about climate change and trade with some trepidation because there's such a deep understanding of the issues here. And there are some books which you read and you think, well, I might have written that had I thought hard enough. Of course, other books you say, I hope I would never have written that. But but looking at the book by Gary and his co-authors, I don't think that I could ever have gone into it with that kind of thoughtfulness and detail. So it's a very attractive, important piece of work. And I'm not going to try and compete with that in terms of the technical detail of the international trade system. What I'd like to try to do is set out how I see the international global deal on climate change developing through all the various interactions I've been having over these last months and years, and relate that to issues of trade and see where trade and international transactions more generally are going to be important in taking that deal forward, or indeed making it difficult to take that deal forward. So let's start then with a very quick description of the global deal. I'm not going to, in this group, explain why we need the kind of cuts that we need. I'll just dive straight into them and say that if we're going to manage the risks of climate change, we're going to have to, as a world, at least cut by 50% by 2050 relative to 1990 in the annual emissions. That means take the emissions down from something like the 40 gigatons of CO2 equivalent per annum in 1990 down to something like 20 gigatons per annum in 2050. And that means that we're going to have to end up just a little over 2 tons per capita, because there'll be around 9 billion people in the world in 2050, 8 billion of which will be in currently developing countries. So we've got to get down to something a little over 2 tons per capita. If the rich countries' actual emissions drop to zero, then the 8 billion in the currently developing world would have to get down to 2.5 tons per capita. So just that very obvious, simple arithmetic of where we need to be and the number of people that there will be in the developing world and in the currently rich world, it's very clear that this is about a global deal, and it's about a global deal in which the developing countries are at the heart of the story. Indeed, we should see that as a deal led by and shaped by the developing world, and not simply a deal which is designed in the rich world, and then there's a careful and gracious and polite explanation to the developing world as to what they're supposed to do. That's not going to fly. It doesn't deserve to fly. And what I hope will happen over these next months will be that the developing world will sit down and say, well, we've thought this through. We're explaining to you rich countries what you have to do, and we're explaining the conditions under which we're going to play the inevitably strong role which we understand very clearly we have to play if this problem will be tackled. And that's the way I'd like to see the global deal developing. Within that, some bits are very clear already. The 80% reductions for rich countries, 1990 to 2050, is really the minimum which the developing world would or should accept. And happily, both the 50% by 2050 and the 80% for the rich countries, all of this 1990 to 2050, actually seems to be more or less understood, which is actually a very substantial starting point for the beginning of this year. There will, of course, be very difficult issues about 2020, and there are two views of 2020. One is that 2020 is halfway between 1990 and 2050. Therefore, whatever you're going to do between 1990 and 2050, you have to be something close to halfway there by 2020. The other view of 2020 is it's 10 years from 2010. And that is very close, and we are where we are, and we wish we weren't where we are, but we are, and we have to work out what's feasible. So that actually is a very simple and obvious dichotomy of views on what 2020 is, but it's a problem. It's a problem because, for example, the developing world says, well, we've been talking about this for a while and you've made commitments, and now you're saying, well, we start at 2010. And all that was learning process, remind you who the President of the United States has been for the last 8 years, and that's not our fault. And, well, it actually is your fault. You elected him. But you can see how those different views of 2020 can shape a question of what should be the ambitions of different countries. So whilst there's broad agreement on where we should be in 2050, not total, but broad, there isn't agreement on where we should be in 2020, and that's going to be a big part of this story. But let's suppose that we put that to one side for the moment. What are the other elements of a global deal? Well, clearly the developing world has a right to expect some help in getting through the transition to a low-carbon economy in terms of finance and of sharing technology. And that will be, those issues are and will be a key part of the haggling and negotiations. What levels of financial flows will there be? What will be the mechanisms for sharing of technology? There'll be intense discussion on that over the coming months. There will also have to be direct action on deforestation, which doesn't fit neatly into any of the sort of broad categories of economic activity. And I think that also is broadly recognised, and the funding for deforestation will be partly through direct support, for example, for Brazil's Amazon Fund, and it will be partly through, and this I think can build up only over time, some contribution from carbon trading and carbon finance. But I think it's fairly clear, at least it's clear in the way that developing countries are seeing this, that carbon trading of some shape or form as a source of carbon finance, as a source of funding to help them move to a low-carbon economy will be absolutely a fundamental part of the deal. So that's clear then right from the beginning when we start to think about the global deal, that trading on this market will be an important part. It's contentious. Some people regard it with deep suspicion, either from the right wing, where they think everything's a con and everything will be hoodwinked and it's all cheating and so on. It might be okay as an idea, but it will never work, all the way through to sort of the very green wing that thinks that somehow it's skiving off from your responsibilities. But I do think that unless there's a substantial element of carbon trading, we will not see the kind of flows that will be necessary to get the action, to support the action in a way which developing countries have every right to expect. So I think we have to deal with those problems. We also have to see that this will be a period of trading which is one-sided trading for a while. One-sided trading in the sense that you gain if you bring down your emissions in a clear and verifiable way, but you are not penalised if you don't. And the two-sided trading, of course, is one where there are a system of quotas, and the people above who go above that in their emissions have to buy, people who go below can sell. And I think that we're going to have to think through what that period of one-sided trading looks like, because there is no way that developing countries will sign up to quotas starting from 2010 or indeed 2011 or 12. Why not? Because they know the importance of low carbon growth, but they don't know what it looks like really. We give ourselves rough descriptions of what low carbon growth looks like, but we all want to see, and developing countries in particular want to see the practicalities. They want to see examples. And so some, starting with a rich country 80% reductions, then some demonstration by example will be very important in this whole process. They'll want to see the finance not just promised, but flowing, both in terms of overseas development assistance, for example, for adaptation, and in terms of support for stopping deforestation and carbon trading. And before committing themselves, they'll want to see that these things actually work, and they'll want to see a sharing of the technologies that come along. So I think we should see this as quite justifiable conditionality from the developing world on the rich world. Yes, we're going to act now. We've got our climate action plans. They're going to be a very important part of the deal. We're all working out what we should do. South Africa, Brazil, China, India, they all have their action plans in some shape or form. Some of them strong, some of them less strong. But this isn't, you sometimes hear the language delayed accession and the cost of delayed accession. This isn't delayed accession. This is a transition period with climate change action plans in developing countries and one-sided trading. And we have to think through how that one-sided trading could work. How do the flows of funds come, partly through trade, partly through other ways, to support that period of transition to taking on explicit quotas, which one would hope for China would be before 2020, for India surely after 2020, many other countries in different positions. So a global deal has to deal very explicitly with that transition period. So this period from now to 2020, 2025, which is the period over which decisions have to be taken, I think is the most important part of this global deal, both in terms of targets and in terms of the ways in which finance and support and technology and so on can come through so that developing countries feel the confidence to take on their own explicit targets. I think that we're going to have to think very hard about some particular features, but let me just offer just one possibility. Suppose that the US sticks to getting back to 2020 to where it was in 1990, which in a decade from now does mean taking off the 15 or 18% that have been put on since 1990. That's quite strong. But of course, if you were getting back as the US to 2020 getting back in 2020 to 1990 levels, and then following through on the promise to cut by 80% relative to 1990 by 2050, it means that that 80% cut has to take place in 3 decades rather than 6 decades. Because 1990 to 2050 sounds like 6 decades, of course it's not if you start from here. But just to get back to 1990 levels in 2020 means, very powerful cuts. You got it, you were at 100 in 1990, you're 115, 118 now. You're going to get back to 100 in 2020, and then you're going to take off 26, 27 a year. So 26, 27 a decade over the 3 decades that go through to 2050. So if you take the next 4 decades, taking off 15 or 18 now, and then taking off 26 and 26 and 26 through the next 3 decades, is just about plausible. But I think the world, actually particularly Europe, will be hoping for something more than that. I'm not convinced that the US can give very much more than that in terms of physical cuts, but what it could do is fund some cuts elsewhere. So, for example, when President Lula comes here to Washington in a couple of weeks' time, one of the items on the agenda could be, well, can we contribute 10 billion or so to your Amazon fund? This will help you in both developing northeast Brazil and also controlling deforestation. And then when it comes to negotiations and discussions, people will have that broader view. And I must say that would be cheap at the price in terms of the story. So when I'm talking about contributing towards and carbon finance, I think we should take a broad view of exactly how that could work. Some of it may be explicit trading through the son or daughter of the CDM, which has to look pretty different from the CDM, but the son or daughter of the CDM could look in terms of wholesale action, in terms of clearer standards on technologies and not using cateris paribus, in terms of sectoral benchmarks and so on. That could provide a mechanism for finance of a slightly more formal kind. But I think we ought to think of the trading part of that story in a more general way. And I've given just one example in terms of support for the Amazon Fund. We also have to think about the problems of, if we move to a big scale in terms of this kind of one-sided trading, or indeed two-sided trading, the problems of very big rents and transfers. Some people would make very big profits. People who have access to very low-cost carbon reductions. Will the existence of those rents disrupt the whole political economy of this? My guess is probably yes. So could you imagine schemes for carbon trading which essentially have more than one price, where people with very low costs or people high costs bid against each other so that they make a bit of a profit, but it's not the whole rent that you'd get from a one-price market? So I think we have to think creatively about different forms of carbon finance, like contributing to an Amazon fund, but which is sort of like trading and might be counted in the overall negotiations one with the other, and we have to think of different kinds of mixed price mechanisms, the kind I just described. So we have to think through, with a bit of creativity, some non-standard stuff, how things might be organised over this crucial 10 or 15 years from now to 2020, 2025. Now let me move and spend the time that remains on more explicit stories of climate and trade, where you're not going beyond trade in carbon and greenhouse gases, but thinking more explicitly about what you've been talking about for much of the day, which is climate and trade in goods more generally. And I'll just make a few points. First, I think, before we get into trade in goods, we should, and goods and services, we should think about the conditions for sharing technologies. That's going to be a crucial part of the story. And I think a narrow intellectual property rights approach to this is not enough. A tremendous amount of what we're talking about here in terms of sharing of technologies is sharing of know-how. And we have to find ways, I think, of incentivizing sharing of know-how. Just one example of that might be joint ventures, where you could imagine IFIs, governments of one country and governments of another country, working out ways to support joint ventures which involve a passing on of know-how. This is not quite like, or actually not very much like, the drug industry, where for the public good we would push people to release patents quickly and allow for things like HIV/AIDS treatments and so on, something different from the standard intellectual property rights that would rule in the drug world, and we do that for very good reason. But it's not this sort of technology, not much of it, I think, is very like that. With a drug, there's a formula for the drug. It either is that drug or it isn't that drug, and you can be very precise about the meaning of intellectual property rights. But if you think of oil companies, what do oil companies do? They combine logistics, geology, finance, some equipment, ways of treating risk, and all sorts of things with equipment. And that kind of activity, and many of the stuff in electricity generation, for example, or cars, is a bit like that. So we're going to have to think of ways in which know-how are going to be shared. So starting with trade in intellectual property rights and conditions for trade in intellectual property rights is okay, but I think we have to think of this in a much richer and more subtle, collaborative way than simply buying and selling intellectual property rights. But it is the case that developing countries are very worried about being pushed into taking strong targets and then being ripped off for the technologies that are necessary to achieve those targets. And it's a question which we have to tackle. So trade in that sense is going to be an important part of the story. Now let me turn to trade in goods and its relationship between that and actions people are taking in cutting down on emissions. Well, of course, the first thing to emphasize, and it sounds banal, but it isn't, is to try to get a global deal, is to try to get everybody moving together. That's the best way forward, and we should think of the kind of trade sanctions as something which we might have to use if we might have to use them, and think positively from the beginning about how to collaborate in order to get a global deal. That's how we approach, that's how we sit down, how we try and solve the problem. And if we start it with the only thing that China understands is a threat, we're not going to do very well in the negotiations. So it does sound banal, let's try to get together in a collaborative spirit and put a global deal together, but I don't think it is. And it's very important that we start off that way and not start by waving big sticks. China's very worried about all this for very good reasons, because they're very vulnerable. And the US and Europe and other rich countries are very worried about this. And to sit down and say, well, what can you do, what can we do? Does that add up? No, it doesn't. How can we do a bit more? And how we can support each other is a much better way to go forward on this than to start off aggressively. The second remark I would make on the relationship between global warming and trade is that for those who want trade sanctions, we should challenge them to get quantitative. Usually it's a slogan without numbers. We're told that other people will cheat and industries will move on a massive scale. There's very little empirical evidence for industries moving on a massive scale in response to environmental legislation and activities. We tried to look at some of that. It's not zero, of course, but it's not big. We tried to look at that in the Stern Review. I think a couple of the authors of the chapters actually are with us today, so if you've got any questions about it, I'll turn you to them, not to me. But to challenge and say, well, just how big is this alleged leakage effect supposed to be? Where's the evidence? Just how big is the cost increase alleged to be associated with not being clean on this issue? Well, in averaged across the economy, it would be 1 or 2% on a cost index. That's the kind of cost calculations that many of us have come up with in terms of the challenge of getting to where we need to be, the 50% cuts by 2050. If those cost calculations are right, and I think they are, maybe even on the high side, then an average tariff from the point of view of a country not behaving on this wouldn't be much more than 2%. It could be a little more if you think that the trade composition of goods is different from the GNP composition of goods and so on. But when people are talking about trade sanctions for people who don't participate in action on global warming, they're not talking about 2 or 3%. They're talking about 20 or 30%. Most of it is green protectionism. And by doing calculations, by looking at the numbers, I think you can expose it for what it usually is. There's some areas, of course, and this is my third point on the relationship between global warming and trade. There are some areas where it's not small, but we know, broadly speaking, what those industries are. Cement, aluminium, steel, paper are the most prominent 4. You struggle to add more than 2 or 3. Everybody will say I'm hit very hard, but those are the industries which matter. Now, on those industries, you could look for international understandings on standards. And already that kind of thing is being discussed in the steel industry. So standards, internationally agreed standards, might be a route there. And if you work hard on those, you may well get them. And if you don't get them, after trying very hard, then you might want to have a tariff of some level that you could work out. But what we have to be very resistant on, I think, is letting the aluminium tail wag the dog of the whole trade story. I went to speak to Confindustria, the Italian Confederation of British Industry. Let me try that again. The Italian Confederation of Industry. And because one of the reasons I accepted the invitation was because Berlusconi at the end of last year had been incredibly hostile to the implementation measures which were being put together for the 20% cuts by 2020 in the EU. And I wondered why that was, because Italy is incredibly vulnerable to climate change. Southern Italy will look like the Sahara Desert by the end of the century if we don't act on climate change. And so in southern Italy, the solar is now more or less competitive on a delivered basis with grid. So I couldn't work out why it was that, predicting Berlusconi's behaviour is not the easiest of things, but why it was that Italy was digging the heels in. And when I went there, it turned out that the president of Confindustria is in aluminium. And it is very important not to let those two or three industries dictate the way in which it all works out. And it's very important to recognise that the reason many of these industries have moved to developing countries over the last couple of decades is to do with costs of production which are way, way bigger in scope than these kinds of things generally. So getting quantitative and dealing with the sectoral issues, I think, could help a great deal. Cap and trade has some margins there which can be helpful. Getting out of this impasse in December on the implementation of the Europe's 20% by 2020 was facilitated by saying that in some areas we'll slow the pace of auctioning, we'll slow how fast we move to auctioning. I'd rather they hadn't done that, but we don't run the world. I mean, it gave a political margin which turned out to be quite useful. I know that Gary tells us that that's actionable, but if you phase it out, if you phase towards your 100% auctioning fast enough, by the time they've caught up with you, you might get away with it. But I'm not an expert on the way in which these things apply. So those are the points I would make before we start going into the tariff story, to try to sort of calm down that discussion and try to get analytical and quantitative about it. And of course, what we want to do is to insist that whatever measures are taken through the WTO and consistent with the WTO, and not just unilateral petulance motivated by one particular group in one particular country. But finally, let me remind ourselves of what we already know and what we live by when we talk about trade and development and growth. But let's keep reminding ourselves of that in the context of climate change. Now, as we make our case politically, I think it will be very powerful to do that. And what we should be doing is arguing the optimistic case on climate change. We have to head off, by moving to low carbon growth, the dire risks to the planet from business as usual. We have to show people that high carbon growth within a few decades becomes a contradiction in terms. It kills itself. It kills itself first on high hydrocarbon prices, but more fundamentally on a severely hostile climate, physical climate. So that we have to make very clear. We have to show people that low carbon growth is actually coming at us very quickly if we look at technical progress and different kinds of investments in different industries. We have to argue to people that low carbon growth is actually got a lot of benefits that come with it in addition to managing the risks of climate change, including a cleaner, quieter, more energy secure, more diverse form of growth, as well as, of course, being the only form of growth that's a real option, because high carbon growth isn't a real option for very long. So being positive about it all, and that this is a growth story, and we have to manage ourselves to keeping down the costs as best we can to this different kind of growth, allows us then to make the stories that we tell about trade and growth very exciting. Yeah? This isn't simply the usual sort of marginal deadweight loss sort of stories, and you have to understand the inefficiencies that tariffs brings. We should keep going on the trade and growth story and give examples of how this kind of thing will work. That as we move to low carbon growth, Suntech is the biggest photovoltaic firm. It's a Chinese firm. You've got big wind, Suzlon, a big wind firm in India. Some of the blades break every now and again, but that's being. I'm sure they'll sort that out. But These are new industries with a lot of competition around the world. They're growth industries, and we all have to get involved. And the more open our economy is, the more chance we have to get involved, the faster these technologies transmitted. Those are the kind of trade growth stories that we have to tell. There's the chief executive of Walmart just a few months ago in China called together 1,000 of his suppliers, and that was just a fraction of Walmart's suppliers in China, and said, look, these are the standards which our customers are demanding of us, and these are the standards which we demand of you. Trade transmits, as it were, in these kinds of ways, the innovations that we're all trying to think of. When we set standards for cars in the rich world, those transmit themselves pretty quickly. Most of the world runs on unleaded petrol now as a result of the kind of standards that originated in a group of countries. These are the stories of technological innovation and policy on climate change, all of which are magnified by the process of trade. So I think that as we sort of get down into the nitty-gritty of how all these things work, as we have to, we ought to also raise our eyes to the trade and growth story, because the low-carbon growth story is the growth story, and trade is a very powerful part of all growth stories, and in particular, this kind of growth story. So I think we should push this more optimistic, dynamic story very hard as we get all the time realistic and practical about managing the costs of the transition. Thank you very much.
Nick, thank you. That was terrific. We're at 2 o'clock. I'd like to go for another 10 minutes if you could. I know you can stay a little bit. I'd like to ask the first question because I'd like you to elaborate on your last point in the following way. As you well know, having been in Washington this week, one of the arguments frequently made against moving ahead rapidly on climate change is the current world recession. And the argument is being made, you heard it on the Hill, you've heard it elsewhere, we referenced it a number of times in our conference today. What is the response to the criticism that all this is fine, but we can't do it now because of the global turndown, put it off for a couple of years? What's your response to that?
One or two things. Putting things off in this area is really costly. This isn't like a WTO negotiation where if you get bogged down and you pick up 4 or 5 years down the track, you're more or less where you were. In this one, particularly because of the disappointment that this would create in Copenhagen and the disillusion it would create, would mean that you would be going on with unmitigated emissions growing strongly for a while. And that's costly. We're at 435 parts per million roughly now of CO2 equivalent, adding 2.5 a year. If you wait for 5 years before getting going, and I think waiting for 1 or 2 might turn out to be waiting for 5, given the disappointment in around Copenhagen, then in that period your 435 has gone to something like 450 or more, and you're in a much more difficult starting point. It then becomes much more costly. So the first part of this is that relentless ratchet effect of the flow stock process here means that there are real costs to delay. The second thing is that what we're talking about is investment in energy efficiency and in greener infrastructure in the shorter run. The kind of investments we're talking about to take advantage of in this recession are of that kind. And they're the kind of investments that you want to make when the price of labour is low. And that's what's true of a recession. So one is the cost of delay, but the other is the advantage of doing these kinds of things now. And thirdly, if you're talking about a US cap and trade scheme, as I hope you are, and indeed you are, that's going to kick in terms of prices of greenhouse gases probably in 2012. Now, we may not be out of the recession by then. There's a real chance we're not. But let's at least be slightly optimistic and hope that we're out of it by then. So some of these price increases, and there would be price increases, but there'd be changes in relative prices, yeah, would be coming in when you hope that things are looking a bit better.
Okay, questions from the group?
Nick, I want to run a back of the envelope by you and get your reaction. We're in a context now in which the prevailing mindset of the developing countries is that they'll do this if the industrial countries will pay for it. It's not primarily that they're doing it for their own interest. Now the numbers are scary because if they've got 3 tons per capita now. If they were to go to the average, we have the global average of 13 for the industrial countries. That's a delta of 10 or 11. Okay, the carbon tax is $50 per ton to get on the 50-50 path, and there's 8 billion people by 2050. So if this is all basically to be compensated for, that's a flow of $4 trillion per year from the north to the south in 2050. Even if industrial country output doubles by then, that would be 5% of industrial country GDP. So what's your sense of whether the mindset in the key players is shifting toward they're doing this for their own interest as opposed to they have to have their growth, and if they can't get it the normal way, they have to be compensated by the north?
I wouldn't quarrel with the numbers, Bill. The question is, what is the mindset, if you want to use that language? It varies and it's changing. The language used in India is that our national action plan on climate change is the one that we've specified to be in our own interests. And they talk about energy efficiency, solar, deforestation as being examples of things in their own interest. But of course they do all those things make a contribution to reducing emissions. South Africa talks explicitly about things we should do in our own interest, one slice of actions, things we should do because we're part of the world and we have our responsibility in that world, and thirdly, another slice of actions, things that we would want to ask for financial assistance in before we pushed very hard. So they actually categorize quite explicitly along those 3 lines. Brazil's climate change action plan involves around 70% reductions in deforestation by 2020. My guess is that that's probably way faster action than they would take if they just thought of Brazil. So I think these things are looking very different according to which country you look at. China, of course, the most important, quantitatively the most important example, is putting together its energy strategy now, and that's going to be part of the 12th five-year plan that starts in January 2011. And President Hu Jintao spoke to a Communist Party working group in June of last year, using the language of low-carbon growth. And some of us know the economist who wrote that language into the speech. But the point is, if you listen to the Chinese leaders talk about this, they come through very strongly. When Jiabao at Davos was asked after his speech, which is the most statesmanlike and confident speech of all the leaders who were there, actually, he spoke very clearly and strongly about the importance of climate change to China. So we don't yet know exactly what China's energy strategy and the climate change and the 12th five-year plan will look like. But I think they'll look much stronger than China's climate change action plan, which was published in June of 2007. And I think China will look very closely at what's narrowly in its own interests, but will also ask very strongly, what is our role as part of a world where we are now a powerful country with big responsibilities, and where we are tremendously vulnerable to climate change. So I think you've got a spectrum there of perceptions, and they're all changing quite quickly. If we're talking to crude money estimates, my guess is that a few $100 billion would do it.
Nick, just as a follow-up on that, does China, with its $2 trillion of foreign exchange reserves continuing to rise rapidly, expect any financial transfers, or are they limiting their ask to technology?
They want both. We don't yet know how it will play out. I think it's quite understandable that they want both. I mean, China's already over 5 tons per capita, and the world average has got to get down to 2, and a country the size of China has got to be close to 2 if the world average is going to be just around 2. So China hopes to grow by, I don't know, factor of 10 over the next 4 decades, for example. So if you're to cut by a factor of 2, absolute, and grow by a factor of 10, you've got to cut emissions per unit of output by a factor of 20, 95% reductions in emissions per unit of output. They've got the toughest ask, I think, given their growth aspirations of anybody. And I think they will look for help. It may not have to be very long, because once the technologies are shared, and I think the technology sharing will go both ways. We shouldn't look at it as technology transfer. But I think for a period, some kind of element. But for China, it may not have to be huge. But they will be looking for the technologies, and they will be looking for some recognition of the magnitude of the effort they are going to have to make. But of course, it's a mistake with foreign trade, because you've got a lot of foreign exchange reserves. That doesn't mean you're rich. I mean, China's a poor country. Ceausescu's Romania had no foreign debts, but it's a very poor country relative to many of the other parts of the former Soviet Union that did have foreign debts. So I think we, of all people, ought not to confuse foreign exchange reserves with wealth of the country as a whole.
Okay, Nick, we thank you very, very much for being with us today, for your leadership in this process, for your collaboration directly with us at the Institute in these last couple of days. We wish you the best of luck, good speed, and we'll be shoulder to shoulder with you in pursuing this in the months and years ahead. Thanks for joining us today.
Thank you. Thank you. Thank you.